Hey everybody, welcome to Mortgage Today for Tuesday, October 31st, 2023, and oh, what a day it was. And I just don't say that with hyperbole. It really was one of those days, and we'll get into that. UMBS were pretty much flat this morning. They were up 6 basis points, which fortunately they were up, but that ain't a ton. Stocks about the same, with S&P futures up 4 points, while ECI has been an increasingly important report over the last 2 years. Today's result is not far enough from the forecast to have a big impact. Bonds certainly traded in high volume from 8:30 to 8:31, but not enough to erase much of the overnight improvement. Bank of Japan removes its yield curve control cap, which is good for bonds, will tolerate yields over 1%, and they expect more inflation. Lots of softer data in Europe, which is good for bonds. Employment cost index, ECI, came in at 1.1 on a 1.0 forecast. It was 1.0 previously. Consumer confidence fell in October, according to the Conference Board. October's retreat reflected pullbacks in both the present situation and expectations index. Write-in responses showed that consumers continued to be preoccupied with rising prices in general and for grocery gasoline prices in particular. Consumers also expressed concerns about the political situation and higher interest rates. Worries about wars and conflicts also rose amid the recent turmoil in the Middle East. House prices rose 0.4% month over month and 2.6% year over year, according to Case-Shiller Home Price Index. We are definitely seeing a reversal of fortunes regionally, with the strongest areas of 2020 to 2022 being Vegas and Phoenix underperforming, while the weakest areas since the Great Recession, New York, Chicago, Detroit, now outperforming. The A house price index rose 0.6% month over month, which is 5.6% year over year. Apartment list said rents fell 0.7% in October and are down 1.2% year over year, but that's for new leases. Renewals are up 4.5%, blended out it's 2.9%. Then the big news of the day hit. HousingWire was reporting that the Missouri jury finds NAR and brokerages guilty of conspiring to inflate commissions. So the Kansas City jury has found that the National Association of Realtors, Home Services of America, and Keller Williams guilty of colluding to inflate or maintain high commission rates through NAR's clear cooperation rule in the Sitzer-Burnett buyer-broker commission lawsuit. The defendants are ordered to pay $1.78 billion. That's $1.78 billion worth of damages in just Missouri. So other states are sure to follow suit. This has the potential to eliminate the automatic buyer side commission in real estate. So that would leave every buyer up to negotiate how their own realtor is going to be paid, which could lead a lot of them to not use realtors, which now the listing agents have to figure out how to get all those people into their properties. It's going to be a mess. But in the bond market, the first 2 days of the week have had the least to offer in terms of scheduled economic data and events. Yesterday's major expectation was the Fed refunding announcement, and today's was the Bank of Japan announcement in the overnight session. Neither had any lasting impact on the bond market, interestingly enough. In today's case, it was the European economic data that did most to start the day off with lower rates, but most of the gains were erased by the ECI that came in just a bit stronger than expected for third quarter. Traders will have to continue to wait for better data-based evidence of cracks in the economy. At the end of the day, the UMBS was up 5 basis points, which is pretty much flat. The Ginnies were around the same except for that 5.5. Both the 5.5 coupons really sold off, so I guess people are anticipating that the rates are going to stay up here where they currently are for a while. And then that 10-year creep back up towards that 5% threshold. So ending the day, the 6.5 at 99.31. So 99.31 puts us right around that Fibonacci line there. 25-day moving average is creeping down to hold that, but we've had a lot of confirmation right around in that 99.3 down to 99 range. It seems like they just really want to hold around there. But in other mortgage business news, another big one, this one I find interesting and I can't wait to see how it plays out, is according to the Wall Street Journal, Guaranteed Rate and its affiliates are going after hundreds of loan officers who signed 6- and 7-figure bonuses who no longer work there. In some cases, those LOs found new jobs. In others, they were fired shortly before the date when the lender could no longer ask for the bonus back, the Journal reported. For its part, Guaranteed Rate told the Journal in a statement that it is not going to be apologetic about exercising our legal rights in recovery of this money. What G-Rate is doing is hardly unique. Other retail lenders such as Nations Lending, Cross Country Mortgage are also going after former LOs for their bonuses. They're desperate for money, and hey, those LOs signed a contract. So this is going to be really interesting because there were hundreds, if not thousands, of loan officers who went out and took these giant bonus checks, and then the market crashed. They are not living up to it. Now, whose fault is that? That will be up to a court to decide, but it sounds like there's going to be a lot of lawsuits. And as always, we know who the winner is going to be: the lawyers.